had some really insightful comments about why knowledgeable individual investors can have an edge. You talked about one of them. One is allowing yourself to think really, really long term and enjoying that snowball effect. But Kieran, maybe elaborate a bit more on why individuals who are curious and want to learn, those people investing in stocks, like why can they or how can they develop an edge?
Yeah, I think first of all, I want to put a caveat on this in the setting of what I'm about to describe and talk about in this area is likely not necessarily fitting the pattern of what most of the professionals that listen to your podcast would this wouldn't be advice that I would necessarily give them in the setting that, as you know, we both agree that ETF investing is clearly one. Index investing is a great way to go when you have limited time, limited interest in pursuing the study of investing and the different aspects specifically of value investing, which I think both of us have an interest in. But when it comes down to the dynamics of actually truly understanding active investing as an art form versus the passive investment flows of what ends up happening, I think the two or three insights that I kind of had early on was that often the dynamic for active managers, there's somewhat perverse incentives that are happening in terms of how they decide to invest their fund flows overall. They're very incentivized to build assets under management overall. That is how they're going to make the majority of their income. And oftentimes being very different than the index is actually not intuitive, and it's not going to be beneficial for them to raise capital overall as fund managers. And the reason for this is that often when there is the natural vagaries of the market that end up happening, people will look to what they're invested in. And if they see big blue chip stock names overall, they are going to end up feeling comfortable. Well, at least they're invested in common things that I understand and I see, versus most of the variance and potential alpha that might be able to accrue, which essentially means above index value returns, can be achieved in looking at some of the more beaten down spaces overall. And so that's one aspect of things. The second aspect is that the element of the dynamic of your long-term time horizon, it took a while to get there for me, but overall, if you can find above averages businesses and hold them for a very long period of time, and this is in the category of what Warren Buffett has kind of talked about, transition he made from the typical cigar butt investing, which is investing in something that's cheap and then having to sell it very quickly after it approaches intrinsic value. If you can hold long-term compounding investments, it can really achieve an excellent return for you when you find a good quality investment. Now, these are few and far between, but we do have a very long-term time horizon versus most active fund managers are looking in very short time windows overall. The last one you might be alluding to that we talked about that day that I think is missed a lot in the index investing aspect of things is that there's this idea of the percentage of float is applied to index investments. And so to break this down a little bit further, an investment that is being selected will be determined by the percentage of available float to the outside passive investor that can purchase that investment. And if there is a large amount of insider ownership to that, that is, say, an owner operator that's ran that business for 20 years and kept 30% of their net worth and personal wealth tied to it, only 70% of the float would be available in that example. And so overall, you might be getting a setting under which these individuals who have a high concentration of their personal wealth and have a very strong long-term vision for a company, they are ones that maybe might take care of that investment and the long-term productivity of it in a better way, in my opinion. The stewardship is stronger versus some of the ones that have lower insider ownership. And I think that unfortunately gets missed in index investing where you might have less percentage ownership of these strong owner operator companies because of it.
Okay, so to summarize, Kieran, that last point, what you're saying is if there's a company that has high inside ownership, in terms of the shares available to the public, there will be fewer shares as a percentage because of the high insider ownership.